Morning. We're Team V, as in V for victory. My name is Will.
I'm Mo.
I'm Thomas. And I'm Nick.
And we'll be presenting our hold recommendation for the CocaCola Company. We're issuing a hold recommendation with a target range of $54 to $58 in a 12 to 16 month time horizon. Our recommendation is based on the following four factors: the attractive dividend that Coke offers to shareholders, environmental concerns, consumer preference challenges, and the overvaluation of Coke relative to its peers.
So first off, for a company overview, the firm has 6 main operating segments, 4 of which are geographic, and 2 being their bottling investment groups and their global ventures. Additionally, the firm boasts over 500 plus brands, each of which are under one of these 6 product segments. Now, our first main point is based on Coca-Cola's attractive dividend. Coca-Cola has managed to raise its annual dividend yearly for over 58 consecutive years. Despite revenue decreases, along with structural changes over the past 5 years, the firm has still managed to prioritize its shareholders. However, when looking at the dividend payout ratio, it's been increasing since 2010 and was quite high between 2016 and 2018, though declined again in 2019. The overall increasing payout ratio could be concerning in the future, as Coca-Cola may not be able to continue to increase its dividend. This further reinforces our hold recommendation.
The second supporting factor of our hold recommendation is environmental concerns. As one of the top regional polluters in 2019, we believe that Coke faces significant challenges in the future as it continues to become less environmentally pollute less and pollute less. This is done through several programs, including World Without Waste, Every Bottle Back, and Water Stewardship. These programs are available in a couple of different markets. RPET is available in around 12 markets. Every Bottle Back is available in 1 market. So we still believe that the company has a lot of work to do in expanding these programs going forward.
So moving on to our third main point, consumer preference challenges. We use 2 main forms of analysis: Porter's 5 forces analysis and the SWOT analysis, and compare Coke to its peers. And as you can see on our Porter's 5 graph, we have 2 main threats that we identified, one being the competitive rivalry and one being the threat of substitutes. Getting into our SWOT analysis, you can see that Coca-Cola's strength lies in their brand and their brand recognition, and that is one way that they combat those 2 threats coming from the Porter's 5 analysis. Moving on to SWOT analysis, one of their weaknesses is over-reliance on inorganic growth. A opportunity is low per capita consumption in developing and frontier markets, and a threat is the health-conscious consumer of today. So looking at some of the headwinds that Coca-Cola is facing, as you can see, the Asia-Pacific market and the North American market have almost the same case volume, and there's a stark difference in population in those 2 markets. So that brings us to our first headwind, being market oversaturation. The North American market is oversaturated, and Coca-Cola is going to have to account for that, and the Asia-Pacific market is undersaturated. And that brings us to our second headwind, which is infrastructure. Things such as electricity and roads are not always a given in some countries and places like Latin America, Africa, and parts of Asia. And the third headwind is, again, the changing consumer preferences. So looking at the market strategy that Coca-Cola takes, which they have dubbed killing zombies, they use the innovative approach shown on the left, or on your right, excuse me, to renew and revive beverages and change to the changing consumer as well as the changing market. And you can see that case volume has increased as percent with their product innovation every year since 2015. So looking at some of the tailwinds that Coca-Cola has behind it, that China and India segment over there on the far right, that accounts for about 40% of the world population. And in contrast, you can see that they have 53 and 16 respectively for China and India, 8 fluid ounce beverages per person per year, as compared to the almost 630 in the US and Mexico. Another tailwind is the global population is growing, and the target market for Coca-Cola of ages 15 to 35 will continue to grow in the future, and currently accounts for about 31% of the global population. And finally, acquisitions. As you can see in the bottom left corner, Coca-Cola has made more acquisitions than its peers since 2016. It's yet to be seen if all those acquisitions can actually have synergistic benefits to the company as we move forward.
Our valuation is comprised of 4 main segments. Firstly, the dividend discount model. Second, the relative valuation. Third, the sum of parts major equity method investments valuation. And lastly, the DCF valuation. All 4 of these methods culminate together in an average target price of about $54, reflecting a downside of 10% as of January 27, 2020. The weights for each of the methods is 30% for the DCF, 30% for the DDM, 30% for the relative, and 10% reserved for the sum of parts, resulting in a pessimistic target price of $49 with an optimistic target price of about $57. And as of February 28, 2020, The closing price was $53.49, which was reflecting a 1.1% upside with respect to the neutral valuation target price. For the DCF valuation, the weighted average cost of capital is 5.7%, with the growth rate is 2.32%. The growth rate is reflecting a 10-year historical average of the free cash flow growth rate. This value is then simulated onto a 95% confidence interval for the free cash flow estimates in order to derive a lower bound and upper bound using the pessimistic and optimistic target prices of Coke's DCF valuation. These prices, respectively, are $49 and $62, resulting in a neutral DCF valuation target price of $60 even. For the relative valuation, 4 main multiples were used: EV over sales, PDE, price over sales, and book value over sales. This results in an average target price for the relative valuation of $48 with a pessimistic and optimistic target price of 42 and about 55 respectively. For the pessimistic and optimistic target prices, first and third quartile data was used instead of minimum and maximum values in order to get variance found in the sample. For the sum of parts equity investments valuation, Coke is currently trading at 7.15 times its sales. What we did is we took a sample of all of Coke's major equity investments, found the percentage that Coke owns or their interest, and then calculated a derived target price based on Coke's sales trading multiple. This results in a target price of $99. Now, though this is almost double Coke's current price, this is exactly the point. Debatably, Coke should not deserve a sales trading multiple of 7.15 times, and it should be a lot closer to the industry average of 3.2%. This same valuation method repeated again, using Coke's industry's trading multiple of 3.2 times, results in a target price of $44, which is significantly more conservative relative to the 99 from earlier. For the last of the valuation methods, the dividend discount model yields a target price of $39.17 using the growth rate mentioned before of 2.32%. Once again, reflects the 10-year historical free cash flow growth rate. This model also highlights Coke's transition from a growth stock to more of a value stock, as it boasts a consistently growing dividend that is a stable option for value investors. In conclusion, the PE over growth or PEG ratio for Coca-Cola is 4.19, which is greater than all of the peer group models used and all relevant benchmarks, once again highlighting how Coke is overvalued relative to its peers, while also simultaneously underperforming when regarding wealth creation.
So I'll do a quick financial overview of the company. So when looking at profitability, as captured by return on equity, return on assets, and operating margin, there seems to be an upward trend over the years. However, when looking at it, the increase in return on equity primarily driven by the firm's decrease in equity, and similarly, the stable return on assets is driven by the firm's decrease in total assets. And the increase in operating margin is somewhat misleading, as overall operating income has been decreasing. Then looking at asset management, as captured by asset turnover and inventory turnover, it's been declining over the past 5 years. And with the changes in consumer trends, this trend could continue in the future. And finally, the firm's leverage is high, as seen by the debt to capital ratio and the debt to equity ratio. However, if the firm continues to fund projects by liquidating short-term investments, it could offset the issue of its high leverage. Now, when looking at Coca-Cola compared to its peers, it is underperformed in both the income statement and balance sheet when using 5-year compounded annual growth rate. And when further dissecting the profitability through its geographic segments, the North American segment was the highest in revenue in 2018, while Latin America was the lowest. However, those two segments have the same operating income in 2018. This could show inefficiency through the different price volume mixes of each geographic segment. And finally, in the financials, the wealth creation that Coke does through its stock growth underperformed its benchmarks, as seen on the left, and compared to industry competitors, as seen on the right.
In analyzing the investment risks of Coca-Cola, our team utilized the PESTLE framework. We identified several key risks that we believe Coke continues to remain exposed to. These include the social and environmental risks we discussed earlier, along with political risks, as Coke may be required to include additional health labeling requirements on their bottles. Also, we looked at the foreign exchange risks, and as we see this to be somewhat important, as more than 70% of Coke's operating revenue is derived from outside the United States, so they do face foreign currency headwinds. They are able to mitigate some of this through the use of foreign exchange derivatives. To conclude, our whole recommendation is based on the 4 main factors of the attractive dividend, which is a positive, but is also weighed down by the changes in consumer preferences, Coke's overvaluation relative to its peers, and the environmental concerns. Thank you. Yes.
I have a question. You used some of the parts model as, I believe, a 10% weight in your valuation. Going into that, because it sounds like, based on your presentation, you kind of threw it out, or the valuation was so high that you said, well, this maybe doesn't make sense. Going into the analysis, were you thinking of using some of the parts, and did this initial valuation change how you were thinking about weighting?
Originally, when I decided how to weight each of the products, we were going to weight all of them evenly, but like you said, as the target price for the value, or for the sum of parts valuation is so high, we decided to weight it lower in order to counteract the high target price, not to mention the sales multiple being double the index. It doesn't necessarily make sense to give it an even weight, as Coke debatably shouldn't deserve its sales trading multiple of that magnitude.
I think that you mentioned their reliance on inorganic growth as a threat. So hasn't making acquisitions been actually part of their strategy to diversify away from carbonated drinks to more growth-oriented, water, coffee, teas, things like that? So the fact that you're indicating that as a threat, I mean, are you saying that those acquisitions have been low returns for them, or why do you see that as a threat?
So we really see it as not necessarily a threat in itself of making acquisitions, but a threat in that there's still work to be done to get the benefits from those acquisitions. So obviously, when there's a merger between two companies, it's not just going to immediately work out. Yes, you just continue to operate and that kind of thing. But for example, Costa was the most recent acquisition that they had, and it was a pretty large one. We think that could be very, very beneficial to drive growth in the future organically now, but it's still yet to be seen if they can continue to operate at a high level as they were in Europe and convert that into the U.S. market as well, where it's not as established. And there are competitors such as Starbucks that have a pretty good foothold on the market.
Could I see your DCF model again? I'd like to ask you a couple of questions. So you're assuming a tax rate of 33.7%.
Correct.
Is that a statutory tax rate, or is that the effective tax rate?
That is the effective tax rate.
I'm sorry?
That is the effective tax rate.
That they pay 33.7? Is that a U.S. domestic weighted one, or is that weighted internationally, or what? I'm not sure.
It's weighted U.S. domestically as well. The tax rate was derived, again, using the cost of debt calculations as well. So I have a couple of different ways that I arrived at the 33.7, but in summary, it is a effective tax rate derived from U.S. domestic statistics.
U.S. domestic tax rates are currently 21% federal and maybe 5% weighted for state. So I'm curious about how it's so high.
Pepsi's is significantly lower as well. Dr. Pepper's is also lower than Coke's effective tax rate. That is something else we included in our analysis, is that Coke's tax rate is significantly higher than most of the other peers that we considered. But regarding the calculations, we do believe that the number is sound, as we were able to arrive at that conclusion through multiple different methods of analysis.
Okay, and the revenue growth rate, is that for a short period of time, or is that a long-term growth rate?
That is a long-term growth rate,
Okay.
including projections for forecasted 5 years to 2023.
Your projections, or did you use others' projections?
It is a combination of mine and Bloomberg's as well.
Thanks.
May I ask? My understanding about the non-alcoholic, largely soft drink beverage market, at least in more developed economies, developed parts of the world, is that sales are growing at a much slower pace. And so if that's going to hold true for Coca-Cola, where do you believe that the revenue growth opportunities are going to come from for them to achieve an 8% revenue growth rate?
So partially from some of the headwinds or tailwinds that we had, places in like Asia and Africa, China specifically has a lot of assets going towards growing infrastructure in Africa currently. And so it could be in different markets where the infrastructure is getting better, electricity is getting places so they can have coolers for their product, and they can have better roads so they can distribute their product. That could be a big area where they could have much bigger growth than they would in the markets such as the North American market.
There's also the change in consumer preferences where it's leaning away from soft drinks as people are becoming more health conscious, and it's leaning into water primarily, as well as more of an energy drink mix. So there could be potential growth there as well.
So the 8% revenue growth is pretty solid for a consumer staples company. Why do you think that's not a reason to invest in Coke?
Given the other concerns, like the environmental concerns mentioned earlier, the shift in consumer preferences, and the lack of infrastructure in most of their target market, as well as the low numbers regarding China and India, and the overinflation of the North American market as well, despite their 8% revenue growth, if this changes, that is really just one aspect. It's bottled up into just North America. Those are all of North America's statistics and numbers, and that's where they're strong. But regarding all other areas, they're not as strong as they are here. So despite their 8% revenue growth, as it's based on one primary market, it might not be as stable as it seems on the opposite, because it's only held by one main column.
And as mentioned, not all of the top line performance isn't always necessarily represented by bottom line. As I mentioned, North America's operating margin was disappointing. So once again, we have to see how it affects the bottom line instead of just looking at revenue growth as a reason to invest.
Now,
Oh, sorry.
so Coke's going to attract dividend type yield investors. Is that what I'm seeing? Is that your thesis?
More value versus
More value.
growth.
Okay, thanks.
This is just a general question, but it certainly relates to Coke. Do you have any view on whether dividends or share repurchases are more effective in terms of providing returns to shareholders?
For Coca-Cola, probably the dividend, just because they've been able to increase it every year, and as we saw the percentage ratio of their dividend, the share buybacks can also be effective. But for us, this is the consistency of this, as well as the growth in the high dividend payout ratio really gives them a step up on many other companies as far as their dividend payout.
Additionally, as we mentioned, it was high from 2016 to 2018, but once again, hit back to its, essentially, although it's growth, it's more stable growth. So once again, for the moment, the dividend is still, I think, optimal. And let's say the firm's revenue increases do translate to its bottom line. This dividend payout ratio, once again, may stabilize in around the 70% range and possibly decrease, but depending on the firm's bottom line performance. So for the moment, once again, at least for me personally, and I think I speak for the team, the dividend is probably more optimal.
Is it sustainable at that high level long term, you think?
Long term, no, but like I said, we need to see the synergistic benefits of these mergers and acquisitions. And like I said, I know I've said this many times, we need to see the bottom line, how it affects the bottom line over the next few years. Like I said, we can't hit 93% yet. That can't happen in the next 10 years. I mean, I don't think getting back to the 35%, as of right now, looking at the firm, it doesn't seem feasible, but bringing it back to the lower 70s, maybe 60s, we think is possible in the future, and not raising it, as long as it maintains consistent, we're pretty positive that the dividend should be okay long term, depending on bottom line performance, of course.
If you could put a slide that you had up there a little bit earlier, we were talking about over-penetration in the U.S. So when you're looking at a market as mature as the United States, isn't that a situation that a lot of big companies are facing, is that they've kind of gone as far as they're going to go in the United States? But if you look at a Coca-Cola, the reason for owning Coca-Cola was because they're looking outside and they've got so many competitive advantages outside of the United States in emerging markets and so forth. But you're indicating over-penetration in the U.S. as a threat to them. I mean, if you could just elaborate on that.
Yeah, so the threat is not necessarily the over-penetration itself, but it's kind of mixed in as well with the changing consumer trends. So Coca-Cola and their original Coke is sugary beverages that a lot of people are starting to trend away from. It's kind of their per capita consumption, as we had up here, is almost 638 fluid ounce beverages per person per year, which is a ton, and that's going to continue to go down, as long as they don't, or if they're unable to innovate successfully, because people are not only changing to other beverages that they don't create, but they're also currently probably at the top of where they can be in per capita consumption.
But you don't see that when we look at China and India, you don't see that as a source of opportunity in the future, that their drinking habits are so low right now that could be a source of potential growth?
Yeah, definitely. We definitely see that because, again, China and India account for about 40% of the world population. So the fact that they're drinking, such low numbers per capita in comparison to an overpenetrated market shows, a huge opportunity for growth. It's just whether or not Coca-Cola can capitalize on that opportunity. And it's yet to be seen if they'll be able to do that.
Judges, I'm sorry, we're out of time.